China-based property player Country Garden aims to build the world's largest industrialized building system factory in Johor, worth 2.6 billion ringgit. Quoting MITI Minister Mustafa Mohamad, Bernama reports that this facility, which will incorporate technologies from Germany, Italy and China, will help the nation to reduce dependency on foreign labour. He reportedly said that by June 2017, there will be a total of 12 lines in operations, and with the technology transfer, a project that normally takes up to 3 years to complete can be done at a much faster pace. Meanwhile, Country Garden's ambitious, if troubled mega project Forest City is going to invest an additional 5 billion ringgit this year in Johor. According to Bernama, Mustafa says that it's because Forest City has been very bullish about its prospects in Malaysia, and by the end of the year, it would have a total investment of 9.6 billion ringgit here. The report goes on to say the spillover effects of the investment in terms of employment in the next 20 years will equal to 240,000 jobs on the island, with 20,000 construction jobs. 70% of permanent jobs in the project were reportedly offered to Malaysians. Petronas Chemicals posted a stellar performance in its first quarter ended March 31st, with its net profit jumping 120% on higher revenue. Earnings stood at 1.3 billion ringgit as compared with 592 million ringgit a year ago. Revenue went up 49.2% to 4.7 billion ringgit from 3.2 billion. This was because of the stronger US dollar and higher output, sales volume and product prices. Petrochemical product prices have risen in tandem with crude oil prices, which are up from the average of $44 per barrel in 2016 to $54 per barrel in the first quarter of this year. However, Petchem CEO Sazali Hamzah says, despite the improvements, crude oil and as such petrochemical prices is expected to remain volatile. Aside from that, Petchem's operations will also be influenced by its production facilities' utilization rates. Building material manufacturer Chintan saw its net profit in its first quarter ended March 31st, jumping 60% despite lower revenue. Earnings stood at 8.05 million ringgit from 5.01 million last year. It was boosted by wider margins on better performance of its manufacturing sectors, but revenue was 8% lower at 261.6 million ringgit compared with 284.4 million. This was because of a decline in contribution from its building material and ready-mix concrete sector due to slower housing construction and stiff competition. Moving forward, the group says it remains cautiously optimistic on its financial performance due to the challenging business environment. China Sarawak saw its net profit skyrocketing by more than 21-fold for its first quarter ended March 31st this year due to an increase in share of profits of 11.4 million from joint ventures and a reduction in the share of losses in associates. The improvement was also thanks to better performance at its cement division and construction and road maintenance division. Earnings came in at 22.7 million ringgit, up by over 2,000% year-on-year. However, revenue declined 19% to 282.3 million ringgit. Going forward, Group MD Richard Curtis says the group is set to benefit from the growing infrastructure needs in Sarawak. He believes that China will continue to be one of the best proxy-listed investments for Sarawak's economic growth. Analysts are positive on AirAsia's China JV plan, which will see the setting up of a new budget carrier in the world's second-largest commercial aviation market. The carrier has signed an MOU to partner with China Everbright Group and the Henan Government Working Group. The new airline company will be based in Henan's capital city, Zhengzhou. In addition to running the airline, the JV will also invest in building a low-cost carrier terminal, an aviation training academy, as well as a maintenance, repair and overhaul facility. An investment bank believes the deal will be positive to AirAsia's long-term outlook with larger revenue and earnings contributions from its operations there. It's keeping its buy call on the counter with a target price of 3 ringgit 63 cents. MIDF also has a buy call on AirAsia with a target price of 4 ringgit 6 cent based on a higher target forward PE ratio of 10 times FY17 EPS. AirAsia closed 2.3% higher at 3 ringgit 56 cent today.